to 42710. Insurance brought to you by Woolworths. That's the difference. Pay 10% less for 100% peace of mind. SMS breakfast to 42710.
Welcome back to your favourite breakfast show on SABC3. This is Expresso. Now it's just about 10 to 7 and it's time to answer those financial questions. And Warren Wilkinson is here and he's going to give us some tips on a wise way of saving. Morning, Warren.
Good morning.
Great
Hi,
to be with you.
Lovely to be here with you, thanks.
Now, a wise way of saving, isn't savings just savings?
Yeah,
and that's wise anyway, just to save?
Absolutely. I think it's a great habit. But the problem for most of us is that John Maxwell says that fear keeps us from action, and action produces results. So we've got to stop feeling ourselves into action, but just actually put an action strategy together. Now, the one thing we want to touch on this morning is the principle of Rand cost averaging. And it is a wealth creation strategy which allows you to actually protect you from the market. And what I mean by that is that if you just take your lump sum of money and you throw it into the market, you may be buying it at expensive levels. Or you may be buying it at the wrong time. So timing the market is never a good idea because everybody always gets it wrong. So Rand cost averaging is the principle of buying in at different levels throughout the market. And this is not a particular share, but it's maybe a basket of shares that you've got. And as the shares are growing in value over time, you find that you've bought it at different levels at different price values. So there you may be buying it at a maybe expensive level, but there it's more of a cheaper level. And so when the markets are down, you're consistently buying into the market over time.
Now, is this the same as phasing in an investment?
Pretty much the same thing, because if we look at the second part of our board here this morning is you can also do that with lump sums. So people who have inherited money, or people that have won the lotto, or people that have come into a windfall, there's no point in just dumping that money into the market. What we do is we phase it in. In other words, we'll put it into a money market account, and then from there we will develop a strategy of buying into the market when the right opportunity arises. And again, what I also want to stress is not only does Rand cost averaging protect you from buying at the worst possible levels, but you're also diversifying your portfolio with different types of investments that you make, because we're not only investing in a particular, all your eggs in one basket. We're going into listed property. We're going into holdings into banks and resource stocks and commodity stocks, pharmaceuticals, your telecoms, etc. So apart from buying into the market at various levels, which is a protective wealth creation strategy, we're also buying into a spread of sectors that you're buying into in terms of diversifying your portfolio.
Now, you mentioned earlier that people who've won money or have inherited money, ideal for them. What about people that don't have that luxury of inheriting or winning any money?
Yes. Well, then the monthly commitment that you make, for example, Rand cost averaging is then a very good way on a monthly basis for you to commit. So it's a good strategy because the money goes out of your account as opposed to being the last thing you look at before you spend it on another set of boots. But, it is a strategy and it's a healthy habit that you get yourself into. So we knock fear right out of the park and we get a strategy in place to build your wealth in real time over time.
And what are some of the other benefits of this?
Well, I think if we just look at the actual line over here, as I said, you're getting a fair value for your money over time, and I think that is the crucial aspect of it, because too many people try and time the market. And there was a classic illustration at the end of last year with one of the asset managers showed that somebody who tried to switch in and out of the market when they thought it was best actually was 200,000 Rand worse off, rather than leaving the asset allocation to the asset manager. He was in a balanced fund, and because he tried to switch in and out of the balanced fund into other funds, he was actually 200,000 Rands worse off. So the actual asset allocation of these funds are done by the asset manager, and you need to know the skill set of that asset manager to make sure that you create that real wealth over time.
Well, Warren, thank you for answering our questions today. If you want to know more, all the details are on our website, expressoshow.com. Now, Ewan standing by with Nadia van der Merwe because they're going to be reviewing the movie we saw a bit earlier. It's called Thor.
For a free quote, SMS breakfast to 42710.